Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Hello, and welcome to the Second Bite Podcast. My name is Todd Taskey. I am your host, and today I am asking the question, what really drives value in a transaction? Rather than go on and on and on, in this series, we are asking the buyers. No better person to ask and hear directly from. We've got 8 great private equity executives that will answer that question as to what really does drive value. I think you'll find some recurring themes in here, and I think it's great to hear from the type of professionals that we have joining us for this episode. This is the 5th in the series, the PE Insight series. So if you missed any of the others, you can go look them up in the show notes or in the history of the podcast. If you have any ideas or people you would like to talk to or transactions that you would like to learn more about, reach out to me directly through LinkedIn or through email. We'll try to hunt those things down because they do make great episodes. This episode should be a great one, give you a good understanding for what really does drive value in any transaction, particularly from the view of a private equity owner. I hope you enjoy this episode. Bill Dyer from Boathouse Capital. I want to talk about what really drives value when you make an offer in the companies that you acquire. And I jotted down a few things. So I'd like you to either rank these in order or what jumps out as most important. But what I put down here was company leadership, the deal structure of the transaction, the growth rate of the business, the industry expertise and experience of the company, the cultural fit, or is there something else that I didn't list there that is always important to Boathouse?
So ultimately in every deal, the value post-closing that's created is around growth. And that is growth in revenue and growth in EBITDA. There's a rule of 40 that's often tossed around in these, software as a service, these SaaS deals. There's been now a rule of 70, I think, has been tossed around, which basically the rule of 40 is looking at profitability and growth. And then,
your growth rate and your profit rate. So if you have a 15% profit margin and a 25% growth rate, you add those together, you're at 40%.
You got it. Very good.
That's the things that makes you attractive to the buyer pool.
So that is, quote, an attractive business. And you can apply that same logic to a cash flowing business rather than SaaS business. But if you really, do the analysis and look, okay, what are businesses that are more valuable? Profitability is actually less a driver than growth. And so that's where you've got the rule of 70, I think they're calling it, where you're doubling the emphasis on growth and with one times on profitability. But anyway, that's a long way of saying that growth in a business is the primary driver of value. So that sounds great. The question though is, how do you get that growth? And I would tell you that the very best way to get growth is leadership. And so I've been in this business a long time. Boathouse has done over 60 platform investments at this point in our 15 years in business, something like that. And far and away, the one thing that drives value and growth in a business is the CEO. If you have the right CEO, things tend to go really well. And if you have the wrong CEO, no matter what else you do, you're not going to get an optimal outcome.
So let me ask this. So let's assume, well, do you look at, when you look at an opportunity, do you assume that at Boathouse, because you guys provide a lot of support to your portfolio companies, if these guys had these additional resources that we provide, they would get the growth rate that makes this a meaningful investment to us? Do you guys attribute that when you analyze a deal?
For sure. We're able to bring to the table, obviously, capital. we're able to bring to the table other folks who can help. So we have operating partners that are experts in go-to-market. So they'll help with building out a sales and marketing function that may be immature when we first come into a deal. So we can help with growth in that regard. We can certainly help in bringing in other executives to fill out the management team, and we can help with strategy. Often that is involving acquisition. So we've worked with a lot of our companies to help them, with M&A. And if you don't have experience doing it, it may not occur to you what to do, how to do it. But that's something that we've done a lot and we do very well. So for sure, we think we can bring a lot of value to the businesses to help drive growth. And it's also important that the leader of the business, who's in the business day to day, knows what he or she is doing. And, so having a strong CEO it's just number one. There's really nothing that comes close in my mind.
Great. Bill Dyer from Boathouse Capital. Thanks for that insight. Brian Schmidt from Court Square. Let's talk about things that are value drivers, whether it's platform or add-on. And I think about things like, I made a list here, company leadership, the deal structure, the growth rate of the business, the industry expertise, the cultural fit. How would you rank those, or what would you add to that list that you think is most important in doing a successful transaction?
Yeah, great question, Todd. If I think about this list, I'm going to put industry expertise, and what I mean by that is kind of founder and product market fit above all the other categories. So I'll take a serial entrepreneur that has had multiple exits, and product market fit in their new business all day. Like, that's the reality of the situation. Those folks are hard to find. Define what you mean by product market fit. Sure. I mean, their product has gained traction in the marketplace and is unique, has generating revenues, right? Is profitable as well. And founder fit as well. Is this founder the right fit for the market, right, that he is operating in? Is there expertise on his or her behalf? Is the founder right for the business and for the market?
And that's how you would rank those. Is there anything else you would add?
Yeah. So look, what I'd say is I'd take a good founder all day in an incredible industry versus a bad industry and an excellent founder, because rising tides are going to lift all boats. So we're thematic investors at Court Square first because of what I just said. Other things that are incredibly important that should be considered too: company leadership, right? Businesses are nothing without management. We've seen this time and time again. Great management teams consistently overachieve relative to the normal distribution outcomes. In real estate, it's location. In private equity, it's management. And then the last thing that we look for in businesses here are a sustainable competitive advantage, which could mean a variety of things, but usually it's going to rear its head in a superior revenue quality, so premium pricing, or cost, right? So you have a favorable cost of acquisition for your clients, a unique moat relative to your competitors. Deal structure, Todd, I think you mentioned that. Not as important to us. It's a way to bridge the gap between a bid and an ask. And right. then growth rate, look, it's important. I think growth rate, profitable growth, that'll get you in the door. That'll get people to, take a call and read a sim. But it's the other things I mentioned, I think, are much more important ultimately than the growth rate.
Can you just comment quickly, when you see, how much validity do you put into a growth rate for the future year that is significantly greater than prior year?
Not a ton, right, at first glance. Now, once we get into diligence, we're going to build an incredibly complex, bottoms up analysis on how realistic that growth rate may or may not be. And you can get there pretty quickly to determine how realistic it can be, Todd. So we take our own view of what growth should be for a particular business as we're able to spend more time in diligence.
Excellent. Brian Schmidt from Court Square, thank you so much. John Findlay from Periscope. I want to talk about value drivers. And you guys have a long track record at Periscope of being very successful as an investor. What do you, and I jotted down a couple of things, but what do you find is the most important value drivers when you consider company leadership, deal structure, industry experience, company growth rate, et cetera, et cetera? What's most important at Periscope?
Yeah, I would put company leadership and culture fit as 1A, 1B. We really focus on people first. We focus on the people that we're backing. We want to back teams and add resources and roles and expertise around the existing teams to help them scale and scale more quickly.
So let me ask this, John, because people always talk about culture.
Yeah.
When you're meeting somebody at the beginning, is there something specific that triggers, wow, these guys are really a good fit, either for us or together? Or is something you watch for as a red flag?
Yeah, I think there's a few red flags that have been leading indicators in our history. I think personalities really matter. And I think coming out of management presentations, you can understand if personalities mesh and there's going to be, it's a small sample size, but is there a good opportunity there for there to be a great partnership and collaboration with that leader and the broader team? But there's little things you can look for. Does the seller, does the entrepreneur have a robust set of values that permeate the business? Do they have a mission statement? Do they have a North Star in the form of a vision? How inclusive are they in this sale process? How transparent are they about the financial performance and commercial performance of the business to their team? There's a lot there to understand how an entrepreneur manages the team and manages the business. But also, have they set that kind of cultural foundation that is going to drive recruitment, development, and employee retention? Because at the end of the day, these are very competitive labor markets, and that's the biggest intangible asset in all these businesses are your people. And so we really focus on that. I think with industry expertise, that comes with the territory, in my opinion, with good leadership. Even if someone was newer to a sector, if they're a great leader and they have a strategic mindset and they're going to do the right things to thoughtfully set that strategic plan, execute against it, they're going to become SMEs in those sectors very quickly.
And you had touched on this earlier. I'm shifting lastly to growth rate. In an earlier episode, you talked about, setting expectations, or how important is growth rate in your mind when you look at a business?
I think there isn't when we look at our framework here that I mentioned previously, we don't have specific thresholds for specific business models or specific subsectors that we cover or invest in from a growth rate perspective. Now, we of course want to look at that growth rate compared to how quickly the market is growing. We want to look at how quickly, as we look at cohort analyses and retention analyses, how much your customer's growing and how much is your pipeline growing and your retention rate or your conversion rates, et cetera. But where I start first, and another value driver that I'm very, very focused on, and we are as a firm, is customer retention. And the reason why we're so focused on customer retention is that is what gives us the proof points around your value proposition. That is, we want to see that data connect back to, this is how we position us in the marketplace. These are our unique angles for why we're differentiated. And that is then resonating with the retention of those accounts and our ability to upsell those accounts. So we really focus on customer retention. If we get confidence in that, we believe we have a really stable business foundation to build off of from a platform perspective. And, as investors, that gives you a lot of comfort and option value too, as you think about the ability to grow strategically, not just organically, but now inorganically with M&A to diversify the offering, hopefully upsell additional services into those accounts. Also, hopefully, as we think about verticals and end markets, diversify from that standpoint as well.
John Findlay from Periscope, thank you so much. So Trenton Sisson from Mountain Gate Capital. I've made a list of value drivers, and you can comment on them, you can rank them, whatever. But what I see, there's company leadership, there's deal structure, there's the growth rate of the business that you're buying, there's cultural fit, there's industry expertise. How would you rank those in terms of most important for Mountain Gate Capital, or is there something else you would include in that list?
Yeah, that's a great question. So let me think. It's a really good list too. I think you hit on all the most important things that we do focus on. I would say probably the first one that I would say the most important is that cultural fit, right? And I would kind of define that as not just the alignment of, hey, you're a good person and we're a good person, but really like, how do we think about approaching problem solving? How do we think about challenging conversations? How do we approach like the vision of what we want to accomplish together? All those things are really important. I mean, we jokingly say private equity investments are like marriages because the average private equity hold period is only a little bit shorter than the average marriage. So like it kind of is like, you have to be able to work together. You have to be able to work through challenges together. And you're certainly going to have the ups and downs as you go. So that's first and foremost, like you cannot do a deal if you don't have that kind of alignment. As far as like ranking the other things in order of importance, I'd probably put two very, very close together. The industry growth rate and the company leadership are probably kind of next in tier here. It's very simplistic thought process, but it's basically, hey, look, if we have a really good leadership team in a really good industry, we're going to do outrageously well, and they're going to do outrageously well. If we have a really good leadership team in a really challenged industry, we'll probably do okay, but it's going to be challenged, and that's probably true if you have a really good industry but a more challenged leadership team. And then obviously, if you don't have either, that's going to be a really tough deal for you. So we feel like we screen for the industry growth rate just based on the narrow set of industries that we focus on. So we know going in before we even have a first conversation with management that we already like the industry that we're talking about. So we probably spend the most time evaluating that leadership team and making sure, besides the cultural fit, really evaluating that leadership team. And that's a huge component of what we're underwriting to. I mean, we're investing in almost all people businesses, and you have to have great leaders running those businesses to be successful.
So let me ask this question, because Mountain Gate has a great long-term success of acquiring a good platform business and then tucking in others to round out that offering. How do you manage the cultural fit there? Does Mountain Gate take the lead, or do you let the portfolio company drive it? How do you decide there?
It's got to be led by the management team that's there. So that's a big piece of the work that we're doing when we're evaluating that initial platform leadership team is judging their ability to do integration. And whenever we do add-ons or tuck-ins, I'd say first and foremost, it's always about adding a key strategic capability or geography, or we're bringing something that we can add to the table and being able to have 1 + 1 = 3. That's a paramount, pillar of our buy and build strategy. And then when we think about the ability to integrate those businesses, we kind of go through the same, thought process, right? It starts with that cultural fit. Like, do they fit in well together? Do they get along? Do they approach problem solving the right way? And then how do we evaluate the leadership of that tuck-in or add-on company? And then, look, we are much more hands-on in the first acquisition or two in terms of helping lay out a framework for integration. What are the major things that have to happen? What are the major things that we need to think about? What are the watch-outs, in terms of How do we think about communication to the employee base of that company? Like, what does it mean to be a part of company X now as opposed to company Y? So there's some stuff that we can help with in terms of the seeing around corners, the frameworks, kind of guides. But at the end of the day, the company and the leadership is the leadership, and we're very much behind the scenes, and they're the ones running the business day to day, and they really have to, solve that together.
Trent Sisson from Mountain Gate Capital, thanks for that insight. It was great having you.
Thanks so much, Todd. Have a good one.
Josh Bilmes from Oceans Equity. I want to talk about value drivers. And for you, I want to ask it a little bit different context, because Oceans Equity is now you're out on your own, and you spent 20-ish years with other larger private equity groups. So I wonder how, while we go through this, maybe you can comment on what's different now that you're out on your own versus when you were somebody bigger. But I jotted down a couple of value drivers, things like company leadership, the deal structure, the company growth rate, their industry expertise, the cultural fit, or is there something else? How would you rank those in terms of most important? And is that ranking influenced at all now that you're out on your own?
Yeah, nothing's changed now that I'm on my own. The training you receive and years of experience in M&A, you're looking for a couple of things. And I'll take what's, a longer list of a handful of subjects, and you can really break them down into two. And I'll show you how. There's the business opportunity, the economics of the marketplace, the competitive set, and the services you're providing your customers. And then there's the people that make that company or that business run. So when you talk about leadership, industry expertise, cultural fit, those are the people. To me, and this maybe this isn't the same for everybody, but to me, that's half of the equation. Understanding that I'm partnering up with a team who has a level of sophistication and organization. It's what's enabled their business to rise to the top, where so many don't, or they stay small. There's already something there that's kind of signaled that these guys and this team is perhaps more capable than competitors. Understanding if their vision of where they want to head aligns with yours. If I have an opinion on the macro environment and what the opportunity set is, and it doesn't agree with what the management team believes, well, then we're likely going to butt heads. I'm pushing for growth one way and they're pushing another way. So really understanding the people, what's driving them, the culture, familiarity, intelligence on the space, that's all really, really important. Almost for me, impossible to discern what's more important than the other. That's just one bucket. That's the people in the team, and it's equally important as is the business. The business will include things like, fundamentals of what service are you providing? Is that market growing or shrinking? What competitive pressures do you have? How many competitors are there out there for you to go out and acquire and go accelerate your growth via acquisition? All of those things are important, but the deal structure, the growth rate, that kind of falls on the technical side. The deal structure, it's usually an output of how do we align interests amongst parties, right? It's usually finding a piece of the business where the management team is retaining some meaningful equity and they have growth goals, which is undermining their valuation ask. And so you want to make sure that those growth goals are hit and we're all aligned. And so coming up with some deferred or contingent purchase price to make sure that everyone's driving and motivated to kind of hit those targets. That's a bit of the technical side, but all of that stuff is important too. And so, making sure there's a viable business in a viable market is always going to be key. And typically growth will come with that. And the deal will be structured to make sure that we're kind of bridging the link between the technicals and the people, and everybody kind of behaves in a cohesive unit.
Josh Bilmes from Oceans Equity, thanks for that input. Casey Swercheck from Alterna. I sent you a list of value drivers, and I wanted to get your opinion on them. I think I've got a sense, but and feel free to rank these or to add any, but I gave you choices of company leadership, deal structure, historical growth rate, industry expertise, or cultural fit. How would you rank the top one or two of those, or would you add a descriptor of your own?
Yeah, absolutely. So I would say without a doubt, company leadership's at the top for us at every step of the way. Our model is really built around more of a partnership approach. So we don't want to buy businesses where founders are exiting with our transaction and sailing off into the sunset. We want a founder that has a vision for what that business could become with an outside capital provider. And maybe that's acquiring other entities. Maybe that's organic growth opportunities. Whatever it is, we typically find the situation where that company leader has built the business to a size, 90% of their net worth is the business itself. And so at the end of the day, they would think about risk taking differently if they could de-risk their own personal balance sheet. And so our transaction is really meant to facilitate a change of control, but with a very strong, think 30, 40+% continued ownership of that leader and that main operating team towards that next bite at the apple. And then you're really trying to underwrite not just one, how realistic is that if they want to go, build Rome, that's a different story than maybe acquire two customers or two competitors that they've already talked to and maybe have even hashed out a deal with. But then the second piece becomes, do you have the right players on the team in order to execute on that? And it's one of my favorite conversations with founders when you get to the point where they say, I wear 3 hats at this company. I love wearing one. And the other 2, I'd love to find somebody else that can come in and do that job better than me because I'm not necessarily really great at it anyway. And so we like to invest to support the team to round out the leadership team that can go out and effectuate on that growth plan. And if you can do those 2 things and get both those correctly, done correctly, I think you set yourself up for a really outsized potential.
Do you find that with a lot of the guys you're working with that there has been a hesitancy to do just what you described because A, I don't want to pay for those salaries. I like keeping that money myself, and B, I'm not quite sure how to make a senior hire like that?
No, I think it's where they're looking for some outside perspective. You got to remember, most of the time we're investing in companies where there's been no outside capital ever. We're working directly with the founder. Typically, it's Gen 1, and they understand that there's a lot of things they're good at, and there are some things that are either blind spots or deficiencies for them. That is where they'd like us to come in and help them either move faster or move towards. For instance, our first transaction is a buy and build in the marketing services space. And the founder said, look, I'm the CEO, I'm the COO, and I'm also the CFO, I'm the head of M&A, and I'm also the CFO of this business. So the first thing we did was hire a CFO. And then the second thing we did was move all of the M&A work to our side of the table to allow him to be the strategic leader, visionary of the business, and also underwrite new add-on opportunities as they came in for the strategic kind of 1 and 1 = 3 math, right? And so that's allowed him to move a lot faster, allowed us to control that process and to make sure we've got all the financial systems and logistics set up in place to not trip along the way. And the result of that one, we've done 7 acquisitions in 2 years, and the company's over 5 times the size as when we invested 2 years ago.
And I would imagine the 30% that he's rolled forward is going to be worth a lot more than the cash you got to close.
That's correct. That's where deal structure is on your list. It's an important one. We've structured our deals in a way that it's been very minimally dilutive to the team. So they actually own about 45% of that business, which is almost to the percent the number they own when we invested 2 years ago.
Wow, that's fantastic. Casey Swercheck, thank you for your insights. Bill Sommerschield from Keystone Equity. When you are assessing an investment, there's a bunch of different value drivers, right? Some of it's strategic fit, obviously some of it's size and EBITDA. But I wrote a couple other things down. The company leadership, the deal structure, the growth rate of the business, their experience or expertise in the industry, the cultural fit with you as a firm or the platform company that you have. How would you rank those things or throw something else in there as most important to you guys at Keystone?
So I'd break them down a little bit. Like, to me, cultural alignment and structure are kind of binary, right? And you don't necessarily know it up front, right? But I think as you get to know a team, and we do, again, because our heritage is working so closely with entrepreneurs, certainly in ethics first and foremost, but and how you treat people and employees and all of that, but how you conduct your business and that spirit of partnership between us and them. It's binary. So is structure. We very rarely do a minority investment. We've done a few, and those are where we've known a team for a long time, right? So the majority of our deals are going to be, majority transactions, and those have characteristics with them. So I view those as more, foundational, and you either check that box or you don't. Look, for us, I think the leadership team themselves, the quality and the depth of it is paramount. I can take a good business with a great team and do a lot more with it than vice versa in my mind. I want to have some differentiation in the space, so that industry expertise kind of goes along with that. And then I would just put growth rates. I would put business fundamentals in there, right? Because I think for us, like, again, we roll up our sleeves. We work closely with those entrepreneurs. So everything doesn't have to be perfect. I do want consistency. So if you think about performance consistency, predictable margin, a history of growth, or, even through some tougher environments, like, I'd like to see that consistency. It doesn't have to be world-class metrics across the board, but I'd like to see it. The visibility is a big piece of that fundamental part, right? Visibility to growth. It gets back to data tracking and historical comps from inside your business. Can you show me backlog year over year for some period of time, how your pipeline converts? There's just some basic visibility metrics that really help drive value. I do think there are just general fundamental characteristics around, meeting profit margin expectations or growth expectations in a given industry that has to hit. And I'd frankly put all of that above just a history of significant growth, just because I think if you've got the right team, if you've got the right foundation, our job is to work closely with that team to do the right things organically and inorganically to facilitate future growth. And so I don't need something that's perfect and has grown, 10 or 20% a year. That's actually lower on my list. I don't want it going backwards, but that's lower on my list because we're willing to put in the work with them to get there. So I'd say that. As far as other things that drive value, the big one that's not on your list to us is client dynamics. I would put that pretty high. Again, that's who are your customers? What are what industries are they in? Are they regulated? And so there's some, special sauce you need to operate in that industry. Are they enterprise clients? Are they SMB? And there's different, value propositions there. Where are you selling in that organization? Are you selling at a C-suite? Are you selling with the budget makers or lower in the organization's value takers? What's the consistency of those relationships over time and revenue generation? Like, that's critical. That's one of the first things that I look at because it tells you just a ton more broadly about the business. And then, I think a couple others, the next one I think of is how well invested in it. Is it not in the executive team that's out there talking to clients and delivering on the work, but the SG&A, the depth and the quality of the team, finance and accounting, FP&A, HR and talent. Again, it's not a prerequisite. We're willing to do the work, but that's additional cost that business may need that's not in there. So that gets factored in. And similarly, sophistication of systems and operational approaches. Again, not a prerequisite, but gives you a lot more confidence if it's already in place versus if we have to go in and do the hard work, which we're prepared to do to instill that in a business.
Bill Sommerschield from Keystone, thank you so much. Nick Moritsugu from Imperial Capital. I want to talk about value drivers, and I've got a list which I shared with you. One of them is industry experience, and I think maybe you could just comment a little bit, because I know you guys do a lot of research into an industry to create your thesis before you get into it. So I'm going to imagine you rank that pretty high. But when you guys think about real value drivers in a company, what are the 2 or 3 things that you scrutinize the most?
Yeah, no, great question, Todd. And yes, we absolutely spend a lot of time upfront doing diligence on an industry. So I think, fit with one of our industry theses would be a really important, almost pre-screening criteria before we get to company specific stuff. And I think of some of the variables you listed. I mean, the first thing I would focus on is just business quality and historical financial performance, which we touched on in some of the prior questions, right? So looking at the individual asset to say, is the company growing? Does it have, a sustainable and healthy margin profile? Does it have good cash flow characteristics? So some of those very basic fundamental business quality questions. I think, another very important variable to me, in particular with founder-owned businesses, is spending time with that individual who's running the business, understanding their motivation for a transaction, understanding what they want to achieve, and what type of partner that they're looking for. Because as I've mentioned to you in the past, we're often looking for transactions where individuals want to take some chips off the table, but also want to roll over and be partners with us in creating a larger company. And so that's a very, very important piece for us. I think you called it cultural fit, right? And I think that that matters a lot. And I think the third variable I'd point to absolutely is deal structure, right? So, what is the valuation of this business? How does it fit with our overall thesis? And what do the terms and conditions look like that we'd put in this LOI? And I think, those are the three that I'd highlight personally. But there's a lot that we have to factor in and put together into our decision-making criteria.
Sure. Let me get your input on this. A lot of times in a deck, you'll see future projections with significant growth, or let's call it growth at a greater rate than what historically has been. How much weight do you really put into those, a projection like that, or any future projection?
Yeah, it's a great question. Listen, we look at it and it's not necessarily what we put into our model, right? We scrutinize the different drivers and generally we'll come to our own view that generally speaking is more conservative than the management case. But again, it requires a look into the actual underlying elements of the forecast, right? We like to look at things like price volume to build to revenue, right? So we like to kind of get a few levels deeper than necessarily what's on the summary page and really validate what the different elements of that forecast are. And we often spend a lot of time with management teams when we meet them going through that element of the business. Because I think, at the end of the day, yes, we're capitalizing an earnings stream and we care a lot about historic performance, but we're going to make our money based on what we're able to achieve together, right? And so I think we tend to spend a lot of time also forward looking on what can we do to help drive performance, help accelerate growth at the business, because that's ultimately how we're all going to succeed.
And I'm sure that's a big part of the reason why you guys have been as successful as you have. Nick, thanks for your comments. Super insightful.
Appreciate it, Todd.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.